I want to start by asking how surprised you've been at how much more downbeat your new CEO is in terms of how much left there still is to do to tidy up those legacy issues compared to where you and his predecessors had it just recently.
Sure. I don't consider it to be that downbeat. I think he's doing a very thorough and exhaustive review of each of the businesses, both for...
The market makes it downbeat. You're down 5% today.
Right. I think there is a level setting of how long it'll take and how much it will cost to get there. I think at the same time he gave his observations, his early observations on the power of the franchise, on the people that he's met, on the relationship with customers. In our quarter, we're growing our customer counts. We're growing several of our businesses. Loans grew across the board. Deposits grew. The underlying franchise is performing. But getting risk and control right and all that it takes to do that, what it costs to do that, to make sure that we live up to our own expectations and regulatory expectations is absolutely his first order of business. So I think he was very clear about that.
I absolutely agree, John. There was a lot of positives he went through as well, and including framing how much opportunity there was to build again on the great franchise you have. But nonetheless, undoubtedly, you look at the market and the share price move, the key takeaway was how much more downbeat he was in terms of the problems there still are to solve than you and his predecessors were over the last year. So I guess my question is, what has he been able to uncover that Alan Parker and Tim Sloan weren't able to uncover?
Sure. Well, I think with the passage of time and with new people in lots of seats, recall that our operating committee is more than 50% reconstituted over the last year or so. All of those folks in digging in doing their work and their specialty have come up with incremental plans and requirements as part of what good looks like. So he's got the benefit of that. He's got his own experiences and having been through something similar at a prior institution. He's got a different relationship with the regulators as he faces off and talks about their observations and what we're doing about it. I think all of those things put him in a great position to be able to process all of this and have a point of view about what it takes. And I don't think it's appropriate for him to try and be rosy or optimistic or allow people to imagine that this is something that's going to go away very quickly when there's a lot of work to do. And that's what we're setting about doing.
As you mentioned, a lot of changing of the guards in the management positions around you and that more downbeat nature. Has it been tough for you, the old guard, and your colleagues to take? Is morale pretty low?
No, I don't think so. I mean, I miss some of my colleagues that I worked with for a long time. As Charlie mentioned, we've got a familial sort of environment, but it has been very powerful and refreshing to have people joining who have walked a mile in these shoes, who have seen something similar at other firms, both U.S. G-SIBs, European banks, and elsewhere, to be able to add that element of been there, done that to solving big problems and coming up with real execution plans and getting it done to satisfy regulatory expectations. So by and large, I think if you were to take a poll, people feel really good about the optimistic step forward and the fact that we're now surrounded by folks who have accomplished that in their careers.
John, it seems very clear that Mr. Scharf made no bones about the fact that this will take some time. He still has a lot of digging to do and things to get his arms around. So if you're a member of the board, how much time reasonably do you think we should be expecting to see some material turnaround here?
Well, I mean, between him and the board, I do think that as he goes business by business and we all do it together with the business leadership highly engaged, with each passing quarter, certainly through the first year, he'll have a really good sense of what he thinks it takes. And I think the plans, our plans will reflect that. And of course, the board's privy to that. So, I think quarter by quarter, more will be known. And particularly initially internally and then ultimately among our other stakeholders, people will come to understand the story and be able to hold us accountable for the execution of that story.
John, I want to talk about the macro environment, listening to your call and the other calls. Get the sense that there was a bit of a pickup in optimism on the corporate side in December. Did you see that, and do you put that down to trade tensions easing ahead of the trade deal being signed tomorrow?
I don't know if it was December, but certainly the initial agreement to have a first stage agreement seems to have taken a little bit of the uncertainty and pressure off of trade, which was one of the bigger overhangs, I think, on risk taking and CapEx in in the business sector. And so while it hasn't completely abated, it's not worse. It's probably a little bit better. And, stepping into this year with that going in what feels like a more positive direction and not in a negative direction, I think is comforting. The expansion, if we're at, call it a 2% expected GDP growth rate for 2020, the expansion's broadening geographically, it's broadening by industry. There's reason for optimism right now in the U.S.
John, on the topic of optimism, back to Wells Fargo, some of those long-term opportunities that Charlie mentioned, the franchise, et cetera. Clearly, you guys used to have a big multiple premium to the sector. Do you think a chunk of that is gone forever? Or do you think that it's all recoverable again in the future?
Yeah, I think a big piece of it's recoverable, and that ultimately we should probably settle out where we used to, which is between a pure play regional bank, which may have a similar business model but would have lower capital and liquidity requirements, and so you have a smaller denominator for ROE. And as you mentioned before you had me on, there's a linear relationship between ROE and price to tangible or price to book in bank stocks. So our ROE, if we're operating efficiently with our mix of businesses, should be, it might be a little bit below a high performing or the highest performing regional bank through the cycle. That is, there are some GSIBs that are performing, at the top of the cycle right now, but my sense is that we should get that back.